Arguably the most successful trader of all time died last Friday. And although his trading secrets remain closely held by the firm he founded, he did leave an important lesson for the rest of us. I'm going to chat a bit about Jim Simon's legacy, discuss one of the most successful retailers, Costco, and take your questions today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. If you have a comment or a question, please be sure to subscribe and leave it in the live chat, and hopefully we can get to it later in this live stream. Jim Simons, quite possibly the most successful trader of all time, died Friday in New York at age 86. For 30 years, his firm's Medallion Fund produced nearly 40% annual returns, that's net of fees, more than $100 billion in gains, a feat unmatched by any of the most famous investors in the world, including folks like Warren Buffett. While it's quite unlikely that any of us will ever achieve that kind of success, that he was able to do so did test an important hypothesis held by many students of the market. And I think we might actually have a clip of him talking about it, and we'll see if we can pull that up for you now.
There's something called the efficient market theory, which says that there's nothing in the data, let's say price data, which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true.
I don't know if any of you heard what he had to say there, because I was able to see it in my screen, but I didn't happen to hear what he was saying. But I will give you the gist of it just in case you did not. What he was talking about in an interview on that video, which he gave in 2015, he described something called the efficient market theory. In fact, it's more commonly known as the efficient market hypothesis. And the efficient market hypothesis is a view that I suppose is most closely associated with Eugene Fama from the mid-20th century. Burton Malkiel, I believe of Princeton, also wrote a book about it called The Random Walk Down Wall Street. And in fact, the idea here is that all of the available information in the market is being aggregated essentially by all market participants. And the net effect of it is that securities prices at any given moment in time essentially reflect all of that known information. And because of that, it isn't possible, those that espouse the efficient market hypothesis view, and there's various forms of the efficient market hypothesis. There's a weak form, there's a semi-strong form, and there's a strong form. The weak form posits that all of the information that is embedded in securities prices, historical securities prices, which is easily observable, has been completely absorbed by market participants and weighted appropriately. And consequently, that view would suggest that technical analysis has no merit. Essentially, that you cannot divine any unique insights about how stocks behave by taking a look at their past price behavior. The semi-strong form of the efficient market hypothesis posits that new information is digested efficiently and quickly by the market, and consequently, fundamental analysis doesn't actually yield any meaningful or usable insights. And the strong form of the efficient market hypothesis, and I think this is the one that would allow us to call any part of this into question, suggests that no information, inside information or otherwise, provides a tradable insight when it comes to making investments in securities. And what Jim Simon says in that video, and again, I'm not sure if you guys heard the audio because I was unable to, and hopefully you were able to hear it, is that that's just not true. And he actually even indicated that even just the pricing data, that there are anomalies that can be detected. He referred specifically to commodities as an example, that even technical analysis of a sort can yield meaningful and tradable insights. And I'm inclined to believe him. if he says so. And I think that's one of the most important lessons that he can leave the rest of us as market participants, because otherwise what we're doing here is just wasting our time, and I don't think that's what we're doing. But it also occurred to me that maybe we should have some understanding of where an idea like that might come from. So there is a book that was published by James Surowiecki called The Wisdom of Crowds. And in The Wisdom of Crowds, he highlighted several examples of how information that is aggregated by a large group, that the collective wisdom, the wisdom of any individual expert within it. And the reason for this is that the individual biases and errors of individual participants in that group essentially offset one another, and the average actually is going to reveal much better things. We may, in fact, even have a graphic about this. So there was a gentleman by the name of Sir Francis Galton. This is actually one of the earliest stories in the James Surowiecki book, The Wisdom of Crowds. In 1907, Galton, who was a bit of a statistician, went to a county fair. Now, the county fairs in those days often had to do with the livestock trade. So I mention that because people would bring and show their animals and people would purchase them. This was a group that surely had some people who didn't know anything about it, but also had a large number of people who did. And in that county fair in 1907, so well over 100 years ago, 787 people were asked to guess the slaughtered weight of an ox. And what they found was that the collective guess, the average of all the guesses made by people, some who had no clue and probably had very bad guesses, and some people who would have been experts, perhaps the owner of the ox, perhaps butchers who were, they're purchasing oxen, that the collective guess was actually within 1% of the actual slaughtered weight. And the chart that you see here illustrates essentially how the more participants you had guessing, the better the average guess became, until essentially it converged upon the truth. And so this, I think, it's this idea from whence the efficient market hypothesis might emerge. And actually, this should also make some sense to us. I mean, when we think about market participants who invest in a company, some will invest in a company simply because they like the product. They have no idea how the company is valued. And there are others who are intimately aware of how the company is valued. But collectively, they are able to make a better guess than any one of them can individually. Now, the interesting thing about this, of course, is that academic studies about this phenomena have illustrated that whether or not this is effective depends greatly on how independent these opinions are. So if you put everybody into a room and they have a long conversation about how much the ox weighs or how much a stock is worth, it's possible that those views become contaminated. So one of the things that this hypothesis relies on is the notion that the estimates that people come up with are independent of one another. And I think we can say that in many contexts, this isn't the case. There are echo chambers. We speak to each other. You're watching this video. There are others that are watching others. And consequently, views may coalesce simply because they're being debated, or it may end up that people end up focusing their time and attention thinking just the way someone who is a quote unquote expert might think. Okay, so what does this really have to do with anything today? Well, from my perspective, I was very interested in what sort of prompted all of this, other than the fact that always interested to learn from one of the greatest success stories in the investing world and what his insights were. But what particularly interested me was that about a week ago, a company that I happen to like that's been on the Holly Index I was just taking a look at its valuation, and that company was Costco. And I think what I'm going to do here is just show a couple of charts about Costco, because Costco hit, last Friday, hit a fresh all-time high. It fell off a little bit from that since, but here it is. Actually, I think somebody had specifically requested that I put candle charts in here. So let me do that. So this is a candle chart of Costco. We can see it hit this fresh all-time high. Now, we often talk about earnings when we talk about companies. That's usually, first of all, every publicly traded company is going to be releasing earnings 4 times a year. It's an obvious catalyst. Many times there's, we can get a read on what might be going on, across the economy more broadly. Costco, in addition to releasing quarterly earnings results, also releases their sales results. And the most recent sales results were released last week. I believe it was on the 8th. I happened to just take a look at their press release. The company reported that their April sales increased by about, I think it was 7.1%. That was the total. Now, Costco gets about 72.9% of their total revenues from the United States. The balance, which they characterize as international, and international is broken up into all international and then Canada. The US, Canada, and other international were all up in the 5+% range, like the mid fives. The only thing that was up more than that was e-commerce. So I think that's, it's interesting and arguably important, but 7.1%, that's year-on-year sales growth for the month of April. Okay, so the market responded very favorably to that. The stock hit all-time highs. What has also happened is that the stock has, at the same time, hit all-time highs in terms of valuation. So I'm going to pull from this chart now. I'm just going to take the price out of this. And what we are looking at is the price to earnings ratio. And I'm just going to make this as big as I can so we can just sort of see how this compares to history. So this is back in the tech bubble, 99, 2000 over here on the left. And over here, obviously up until late 21, we had quite a rally for US equities. And then here we are, reaching almost 50 times. So another way to think about this is, okay, well, how does that number compare to the multiple of forward earnings? Because trailing earnings, while it's interesting, of course, the other thing we should be interested in is not what a company has done. When you buy a stock today, or if you sell a stock today, what you're really interested in is what that company is going to do tomorrow. If you own the stock, essentially you've already received all of the earnings that the company has done in the past. And if you're just buying it, you don't get any of it. Either way, what has happened has happened. What's done is done. In the mixed metaphors world of the movie Margin Call, I think John Tull at one point said something about that spilt milk under the bridge. So we don't care that. We obviously care about historical operating results in as much as it gives us some sense, and I'm going to get to this, on how they might do in the future, but it's really the future earnings that matter. So how does it trade relative to the consensus for the future? And right now it's trading about 46 times the forward earnings estimate. Is that a reasonable number? Just because it's high historically, that doesn't necessarily mean this is a high number. So as an example, we could look at a company like Nvidia. Nvidia traded at high multiples historically, and actually, why don't I just put that in here so we can give that some thought. This company, too, traded at some pretty heady multiples, and we have some anomalous data in here, so I'm just going to get rid of that. Let's go back to, let's call it 10 years. And here you can see that at various times, Nvidia has traded at very high multiples to estimated earnings. So what the street's consensus view for what the company might do in the future. And this number will float around based on a couple of things. Obviously, the price of the stock, and obviously the consensus for what the company is going to be able to deliver in the future. In Nvidia's case, one of the things that the company was able to deliver was extraordinary earnings growth. And the more extraordinary the earnings growth, and we can see that here highlighted in purple. I'll just make that a little more prominent if I can. If you can deliver that kind of extraordinary earnings growth, then a very high turn is justifiable, particularly in cases like Nvidia's, where they're dealing with a secular trend where the end isn't really in sight just now. We're early innings, I think, for the investment in AI infrastructure, in Nvidia and Supermicro, and arguably AMD. These are companies that are right at the center of all of this. But where Costco is concerned, Costco, and here's one of the reasons I described in a tweet a week ago how I love and hate Costco at the current levels. Why do I love it? That is because over the long term, this is a company that has delivered remarkably consistent earnings growth. Here's a 3-decade-long chart of earnings per share in Costco, and we can see what this looks like. Now, one problem I have with a chart like this is that when you look at a chart like this, because you're looking at it over such a long time series, it basically looks like earnings are hockey sticking. So your perception might be, kind of like it was in Nvidia's case, that the pace of earnings growth for Costco is accelerating. And the truth of the matter is that that is not necessarily the case. And I actually created a chart which I think illustrates this a bit. So just bear with me while I show this. And hopefully we can get this to a form where you can kind of see what we're looking at here. So what is this chart of? Let me just get this back. So this is over a similar time frame. So once again, we're looking at both the price earnings multiple for Costco, and we are looking at their earnings. But I made an important change to the earnings here. And I'm just going to highlight those points. That's in blue. So what is the difference? The earnings in this case, once again, over a nearly comparable period of time, is the earnings per share for Costco, but this time in a log scale. And you can kind of see that if you take a look at the right axis here. So there's basically two axes. The left is price to earnings multiple, so you can see that's up around 46 right now. And the right is the growth in earnings per share. And you can see that it's very monotonic, steady from the lower left to the upper right. It's interesting if you take a look at the earnings growth, and this is more true recently, and when I say recently, I'm talking about the last 20 years, not the last 30 or so. But over the course of the last 20 years, the earnings growth for Costco has been fairly consistently around 12% compound annual growth rate. Now, 12% compound annual growth rate is exceptional. To put things in perspective, the S&P earnings growth rate is probably between 6.7% and 7% per annum, so that is substantially better than the growth rate that you get from the S&P 500. And of course, the growth of the S&P 500, one of the reasons that equities are typically such a good investment over the course of time, is in turn about double the rate of real GDP growth. And this should make some sense to us. Well-managed businesses essentially find a way to win. That's one way to sort of think about it. But the question I have for us to ask ourselves is, does such monotonic and exceptional sales growth of 12% justify a 45 or 46 turn of forward earnings? And to think about this, I basically took a look at the earnings growth of two other areas. Now, I didn't create the same kind of logarithmic chart for those, but interestingly, if you take a look at consumer discretionary stocks, and I consider Staples to sort of be more of a Costco to be more of a well-executed staples company than consumer discretionary. I mean, they are, after all, selling. They do have some consumer discretionary items there, of course, but they also have, a lot of staples. I mean, we're dealing with groceries, we're dealing with toilet paper, those types of things. And what we find is that if you take a look at the staples sector overall, so it's growing at a pace faster than that. So this is, and I can't actually get the EPS for the XLP ETF, which I'm going to show the performance of that in just a second. But the Consumer Staples Select Sector Index is, I do actually have the EPS for that. That's IXR. Here we are. So we're going to just take a quick peek. And again, because I don't have the logarithmic chart, this is going to be a little bit more difficult to detect, but you're going to have to take my word for it. I was looking at this independently. So we're just going to get rid of the price because I think that clouds the issue, and I might actually even get rid of the trailing price to earnings and just put in the best. But if we go back over the course of time, it doesn't look like it, but this earnings growth in this sector, the compound annual growth rate. So what do we have here? This is the PE. The compound annual growth rate of the basic EPS is, so that's about 3.5% according to this. So that's essentially growing at the pace of the economy, give or take. And then if we take a look at consumer discretionary, the pace of earnings growth there is substantially higher. More like the S&P. The thing is, if the consumer discretionary space is growing at the pace of, let's call it the S&P, or even a little bit faster, let's say, something closer to what Costco actually might be generating, it's trading, 26 times forward versus 46. I think we're getting into awfully heady territory for Costco. Now, the company's going to be announcing earnings pretty soon. They're going to be announcing earnings at the end of this month, on the 30th. Street's looking for about $3.70 a share. Not a really big implied move. Now, here's one of the things. I always get a little bit reluctant to suggest to people that you might want to sell a stock that I think is as well managed as Costco. And let's just talk about something else that I think is a real positive. It deserves mention before we go any further. And that is, Costco, unlike other retailers, derives a significant portion of their revenue from an area that doesn't have margin considerations the way other retailers do, and that's because they charge subscription fees. So if you are like we are, members of Costco, and they have various tiers, they haven't actually had a price increase lately, so it could be that people are anticipating an increase in the subscription fees for the various tiers of membership to Costco, and that's a potential boost. But I will say that since I don't want to encourage people to sell the stock because you may have tax consequences. Maybe you don't. Maybe you won't. If you have a tax deferred account, it won't affect you. Broadly held stock. But this is not just a broadly held stock. It is a stock that I recently was on the phone just last week with a very large private wealth bank, the largest, which should give a hint, but I'm not going to say anything else about it, so I don't get into trouble with them for saying so. But this is basically their number one holding, very broadly held, and it got me thinking about the wisdom of crowds. The wisdom of crowds in this case is that Costco sells staples, they get subscription revenue, they have more immunity to potential economic problems, and so you should buy it. And all of those reasons are good reasons to buy a company. The problem is that you can't buy a company at just any turn, at any multiple. Things make sense, but they make sense at a price. And I think the price of Costco has just gotten a bit too high. So if you do hold the stock and you are in a circumstance where there are potential tax implications for selling it and you don't want to, normally I do not advocate selling calls going into earnings, but I don't really mind it this time around. I was taking a look at June, and we'll just take a look here at. I'm just going to put this in as a potential covered call. Now the stock is down a little bit today. I was actually looking at this over the weekend, and I think I was looking at it might have been the 820s or so, and it looks like you can't get quite that same price for them now. Perhaps the 810s. But you could sell some upside calls that expire in June. In this case, I'm looking at the 810 calls for over $12. And so you'd be getting more than 1.5% of the current stock price. And I would add one other thing, which is that the 810 strike, in addition to being what would turn out to be yet another all-time high, you still have some room for capital appreciation. Right, so there's 4.5% of upside for you there, 1.5% in terms of premium collection, and I just feel like we're getting to the limits of sanity here. There may of course be information that I'm not seeing, but one of the nice things about having a company that has had such a long operating history and where the earnings growth has been so consistent over time is that forecasting how the company is going to do in the future in the absence of something very, very different about their business model shouldn't be that difficult for us. And this is definitely getting towards the upper end of the range. One other quick point I would make that an analyst made to me about Costco, and that is that at various times in the past, the company has, in addition to the conventional mechanisms by which companies try to return capital to shareholders, actually issued a special dividend. Their most recent special dividend, I think, was like $15 a share and came in 2023. And this one analyst I was talking to posited that something like that could be in the offing sometime soon. I would push back on that for the following reason. First of all, in 2023, when the company did issue that special $15 dividend, they were sitting on about $5 billion in net cash, and that number's closer to $900 million as of the tail end of February. So I agree that they do have the intent to return capital to shareholders and will continue to do so, but they're going to need to have more of it, I think, to trigger such an event. I don't anticipate that the company is going to have a special dividend when they've got less than $1 billion in cash sitting on the balance sheet. Not that they aren't sitting on more than sufficient. The company's got good free cash flow. $900 billion bucks is more than enough for them to operate their business. I don't think there's any vulnerability there. The one growth prospect I see in Costco, which I think is it's worth paying attention to, worth noting, is the growth in e-commerce, because one of the great strengths that the company has is that they have the outlets essentially as a distribution hub. Now, I also made the point on that, and I think this is important too. For those of you who shop at Costco, as we do, you probably know that you go in with the intent that there's some very specific things you want to buy. You never end up walking out of that store not having spent $1,000 on God knows what. And I think it's just because you push these big carts around and you say, oh, that looks pretty good, and that looks, oh, I could definitely use one of those. And when you say one, you really mean 3 or 10 or whatever the industrial size packaged thing that they have is. But I think it's well worth mentioning. Okay, so that's something to consider. And I would also, believe it or not, even consider, somewhat reluctantly, speculative put spreads. I don't have those on, but something to think about. With that, I'm going to move on to some of your questions. And we have one now in URI, United Rentals. Several shows ago, you talked a little about URI. I have a May 17th call spread, 710, 730. Any suggestions? Okay, that was probably quite a few shows ago, but let's take a look. First of all, that is expiring at the end of this week, and we don't have any catalyst. They had their annual general meeting a week ago. It was last week on the 9th. And I'm going to see if I can, I wonder if I have a mechanism for dropping that into the chat. Let me see if I can, let's see if I can do that. There's probably a transcript. I'm going to see if I can, you know, I've never tried to do this before. Producer Jay, I'm going to ask the question. I downloaded the transcript from that. Although you could, by the way, if you weren't a participant in it, my guess is you can probably just go to, they'll have this typically on the investor relations website. And you can go there. So I'm being told that I'll come up with a better way to do this in the future. This was a very spur of the moment thing, my contemplating how to do that. So a couple thoughts on United Rentals. I have a feeling that it is not going to get through the strikes that you indicated. Actually, why don't we put this up on here so we can just sort of take a look at what that trade is. So we're going to put the May 17, 710, 730 call spread in United Rentals up here. Let me just modify this and put this in. So we're May 17. We've got the 710 calls and the 730s. So for those interested, this is the trade in question. At least by our work, it looks like the probability of profit of this trade is less than 25%. So it looks not looking too positive at the moment. You know, I still, you know, I generally like the stock, I have to say. And, you know, it's interesting, over the course of the last 4 weeks, and even over, it looks like, the course of the last 1 week, we did see some price target increases. It looks like the average of the street's price targets for the name actually bumped up by about 83 basis points over the last 7 calendar days. That said, if I was inclined to try to make a little bit of money on this one, I think I would probably be more inclined to try to sell a little bit of premium on these call spreads rather than using debit spreads. There's something else, which is, it just feels, I've seen this now on a couple of occasions, and I'm sure you guys have too, guys, gals, everybody, that on several of the most recent earnings that we've seen, Disney, I mean, Starbucks results, we've talked about that ad nauseum already. But, you know, results that weren't really that poor. AMD's results were not poor, but it definitely traded poorly out of that. Disney traded very poorly out of their numbers. Starbucks gave bad numbers and then had the worst, you know, results post-earnings, I think, that we've seen. It does feel that there is some anxiety in equity market sentiment in these kinds of cases. And so in an environment like that, I'm more inclined to make bets on something not happening than betting on something happening, especially on my bull case. So you could look to, you know, finance your call spreads with, you know, the sale of downside puts, something along those lines. And so for Red State Ron, who has this position on, you could consider, now I don't think there's actually that much premium left in this trade. Let's just take one last look at this thing. Actually, yeah, I mean, according to this, it looks like as of today's close, the mid-market price on that $20 call spread was still more than 25% of the distance between the strikes. So that's $545 in premium per spread. I don't know how many of them you have on. You could look to sell some downside to help finance it. But I would also point out that this is not an event-free week. We have We have PPI tomorrow, and we have CPI the day following. And we could get some real volatility on that. So one of the things you can think about is tomorrow, of course, there isn't any way to avoid this already because we're going to get the PPI data pre-open. So, but I think CPI data is actually going to be more important than PPI with respect to volatility. PPI has sort of been leveling off a little bit. Not sure how helpful that is to you. Okay, Nike is trading below its 200-day moving average and near its 52-week low. What do you think of a June 14th, 91 naked put on Nike? So naked put, naked assumes, usually when someone says naked to me, I'm assuming you're referring to selling the June 14, 91 puts in Nike. And so, Ranjana, if you want to just clarify that, that would be helpful because I'm assuming that's what you are alluding to. Let's take a look at the June 14 puts. And for now, until I get any update from you, I'm going to assume when you say naked that you're talking about selling it. And we have this trade right here. Okay, so I'm actually surprised. Yes, writing it. Okay, so he has confirmed that. That's helpful. Pretty decent probability of profit, it looks like. Not a terrible rate of return either, because you're collecting $1.50, at least you would be, as of the mid-market prices on today's close. So that's 164 basis points over 32 trading days, which is 18.7% annualized. I like the fact that you're considering doing it on weakness. This is actually something that we have often talked about with groups that I've been involved with, which is, looking, you're essentially kind of trading as if you're long gamma. You're not, obviously. And in fact, when you start selling options, you're quite the opposite. But, buying weakness and, buy the dips and sell the rips is the idea. Now, of course, if you have a stock that is in a profound downtrend and you don't see reasons for that to improve, then that could be a situation. I will say we've seen a couple price target increases for Nike. It's still top of the fold, if you will, amongst consumer discretionary names, and it's trading at a valuation. And by the way, this was an unfilled gap that we had over here. You might be able to see, probably need to switch. Yep, there we go. So we had this unfilled gap that obviously had to be resolved back here. We're sort of bouncing along that. Of course, bouncing along the bottom there is also a potentially tricky situation. So we're just going to take a look and see what some other technical indicators, not being a chartist, I'm going to rely on what some other things have to say. Well, it turns out to be a pretty mixed bag. So it's I don't know if we can blow the screen up just a little bit. Let's see. Hopefully you guys can make this out a little. So I want to just tell you what you're looking at here. What you are looking at are just a host of different technical indicators. And you can see what they are. We have fear and greed, moving average oscillator, exponential moving averages, a whole bunch of things here. And all I've done was I essentially sorted these by those technical indicators that have generated the best trading profits, essentially, for this name over the last year, and ranked them. So fear and greed is the most successful had you been following this for the entirety of the last year. Now, this being a Bloomberg institutional tool assumes that you're trading with about $100 million per name, which actually I have to say is pretty ambitious because that would be big even for, you're dealing with a $5 billion hedge fund at least if you're going to trade that kind of size. So aspirational, let's call it that. But what we can see is if you look over here where my cursor is, you can just make out, and I apologize, we'll try to come up with ways to make this illustrate a little bit better. but anything that's is a down arrow means that that technical indicator would be short here. And anything that has an up arrow indicates that it would be long here. If it is green, that means it is profitable since it made that call. If it is red, obviously, the opposite is true. So, for example, fear and greed has been a great technical indicator. It indicated being short. It's down about 1.4% right here. And actually, we can drill into that a little bit further and actually see if, when, and where it would have indicated, that a rule was triggered and you should, go long or short. So technically, it looks like a little bit of a mixed bag. That's probably not surprising given where it is. Let's just take a quick look at valuation too, because I think that can be important. Obviously, this is a company that did stumble a little bit recently, but one of the things you're going to see is that the valuation that we're looking at, while not terribly cheap, is cheap to itself. So if you're going to own Nike, there have been worse places to own it. And right here, I'm just going to draw a line. This is where we are right now. This is a 7-year trading history. And we can see that, at least based on the forward analyst estimate, this is a consensus. We talked about the wisdom of crowds. This is the wisdom of the Wall Street crowds, such as it is. But what you're looking at is the bottom end of the historical trading range in terms of the valuation relative forward. Okay, so there we go. All right. Very early, 3:15. Good morning from Bangkok. Thank you for joining us from Bangkok. Hope all is well there. Is it too late to sell bull puts on Nvidia? Well, let's take a quick peek at Nvidia. First of all, let's just take a look at a price chart. I think that's where everybody always begins. And what we can see is that this one has been sort of chopping around in a range here lately. And that range is not a small one. I mean, we're talking about a range of, call it 750 to 950. Pretty big range when we think about it. Next thing I would be interested in, if I'm going to sell options on any stock, and of course I did a typo, I did it again. The very first thing that I am most interested in is, okay, and this is a tempting one to sell premium on because the premiums can be quite juicy. Are there any events coming up in Nvidia? And the short version to that is, sure, we've got one coming right up. On the 22nd, the company is going to be announcing their earnings. And what is the options market implying for those earnings? So this goes to, usually I don't like selling premium going into an event. I might like doing something like selling it immediately prior and immediately after, unless I'm deliberately targeting the vol crush. So the first thing I'm going to be interested in, they report on the 22nd, what is the options market implying the stock could move? And how has the stock moved historically? The short version is that right now the implied move is about 9.3%, and that is larger than the long-term historical average of just over 7%. So, again, in this little table, hard to make these numbers out, but where I'm highlighting right now, that is the one-day historical average move for Nvidia when they reported earnings going back to 2013. So we're looking at 44 reported quarters of trading history here. And the options market is implying 9.3. So if you were armed with only those two statistics, your first judgment might be, oh, well, the options market is implying a larger than average move. And if I think we're going to get an average move, then I should sell premium. But if you take a look at this table, you will see something else. You will notice that the stock rallied 16.4% last time, and we had a couple other double-digit moves as well. So with that information at your fingertips, you begin to understand why the options are priced the way they are. So as we look at that, I would argue that actually options are not overpriced significantly going into the print. If you are looking at selling put spreads in Nvidia prior, that's going to be awfully difficult because of when they report. So, I mean, you could, I guess, sell some that go to the end of this week. That would be a thing you could do. Now, there is one other thing, which is that I actually think that the news is probably going to be quite good for Nvidia. I don't have any reason to believe that all of the things I've said about sort of the secular trends themselves aren't going to happen. But if you're anxious about those double-digit moves, it might be better to forego some of that really juicy premium. I mean, look at the May 24s. So the May 24th straddle, the 902.5 straddle, that straddle is 48 by 47-ish as of today's close. So, it's basically more than 10% of the current stock price on the straddle that expires next week, which makes sense. Remember, I talked about a 9% move on earnings, plus you have to accommodate the value of optionality every other day as well. So, of course, it makes sense that it would be more than 10%. You will still see pretty juicy premiums coming out of it on the other side, and you'll have an additional and important data point. So if you're comfortable getting long Nvidia here, I think it's okay, but it's not a screaming sale to sell those puts. I guess that's a little bit of a waffle, but that's what we have. Okay, among earnings reporting this week, which one are you most confident going up or down? Cisco, Walmart, Deere, or Applied Materials? It's interesting. Some of the old companies of the prior tech boom, 99 and 2000, Cisco I pull into this category, Intel clearly. I really just have not been feeling very good about these companies. Now, I've had some insights about Cisco since from some colleagues of mine who work there. So some of you who, you may or may not know, for a number of years I worked with a group of AI experts who had sold their prior company, a company named Park Technologies, to Cisco Systems. And of course, if you never worked at a company, if you don't know anybody who works there, you don't know much about the culture of the business, you only know about the good things that they do, because that's typically what gets released, you don't have any unique insights. One of the things that was very interesting to me is that Zoom, I'm talking about not Zoom Info, but when you Zoom somebody, the video conferencing application, the founder of Zoom is also a former Cisco guy. And he used to work on WebEx. And what I learned was that he had, while he was at Cisco, a lot of great ideas about how he thought the WebEx product could be improved. And it turns out he was encouraged. Look, they were very slow moving. They didn't want to adopt his ideas. And they said, if you think you have these really great ideas, you should leave Cisco and start your own business. And if it's really good, we'll buy it. Now, you could think to yourself from a management point of view, well, if you have entrepreneurs working for you and they can develop new things and you have a history of acquisition, you could say, well, that's sensible to get somebody else to risk their capital to try to build a new idea. But I actually don't like this very much at all. WebEx was a stale product. It was the product, and who WebEx is anymore. I'm hoping that they're learning that that's not a good cultural attitude to have, but it isn't. And I think Zoom has now become a company that's probably a little big even for Cisco to swallow. So it took a little bit of the bloom off the rose for a company like that. Now, Walmart. This is an interesting case because Walmart has done a couple things, especially lately, I think quite well. First of all, their e-commerce has really picked up. I think that's a positive. They have focused more on grocery, which is critical at a time when inflation is pressuring consumers for two reasons. One of the reasons is that groceries aren't optional. So this is staples. We were kind of talking about this with Costco. Get people into the store. Maybe they buy discretionary items, maybe they don't, but if they're buying staples, they have to keep coming back for them. And so they, I think, cost-conscious consumers, as they build out the grocery business, are going to be more inclined to shop there, and e-commerce is obviously critical as well. And I do feel it's a bit pricey. I was looking at it before. I think it was trading around 30 times. But, it's a concentrated float. Obviously, the founder's family controls about half of the outstanding stock. And, as expensive as we might think that it is, and it is, arguably a little bit expensive for something that's not really growing the top line by leaps and bounds, it's considerably cheaper than Costco at 25 times. So, I kind of like Walmart for this reason. Target trades about 10 turns cheaper than Walmart does, but they are trying to put grocery into some of their outlets, but they don't have things like fresh produce. What they have is like frozen stuff and dry goods and things like that. And I think it's more of a discretionary type of a purchase. Also, I don't know that Target is quite the value shopper's paradise that some might believe that Walmart is. We don't happen to have a Walmart close to us, and we do have a Target, but so I kind of like Walmart there. And the final, so Deere. Okay, so Deere is going to be largely driven by things like crop prices. Deere is more ag and forestry. Cat is more heavy construction. I've really liked Deere for a long time, was a holding, is no longer. And part of that really came from, our view that we thought that some of the big ag purchases had taken place. And these are expensive purchases. We have seen commodity prices level off a bit. Borrowing costs are higher. The combination of those might lead one to believe that it's not as good a framework. Although I will say, I don't think this company was particularly expensive to itself, but it is more cyclical in that sense. I mean, the thing is only trading 12 times earnings, and let's see where that puts it from a historical perspective. Well, that actually comes as a bit of a surprise to me. I guess it's trading modestly above its historical multiples. I kind of think that this one's going to be a little bit range bound, and it's probably closer to the top than the bottom of the range. That's my thought on that. So that gets us through Cisco. It gets us through Cisco. Not crazy about it. Walmart, I like it. Deere, I like it, but not here. And Applied Materials. What have we been seeing for their growth lately? I'm going to take a look at this one. I actually hadn't looked at Applied Materials. We're still above the 150. We are... I wish I had a good insight for you. I admit that, sometimes you guys ask questions and it isn't a name that I look at all the time. These other companies are names that I look at a lot. This one I don't. It's trading right around its historical number. What do we got on the calendar? We've got, this is probably why you're asking me. See, shows you how up to speed I am. They report on Thursday. And I have another little modeling thing that I like to look at over here, and let's see what we've got. One of the things I often am interested in is when you have an upcoming catalyst, as we do, what are those that cover the name most closely doing? Are they raising their price targets right before it? Because you think to yourself, well, why would you do that? Or why would you lower the price target? The Street really likes the name. And price targets have risen on average by about 2% over the past 4 weeks. But interestingly, the average price target fell just last week. So over the 4-week period, it's actually generally higher. But over the last week, fell just marginally. It looks like by about 1.1% on average. Oh, I'm sorry, 50 basis points was the average. So, it's well liked in the space, well positioned, but just a little bit of an anecdote there. Somebody who actually, let's see, who brought their price target down? Who updated this? Some of the research I may have access to, some of it not. So Jeffries, on Friday, they came out and said hold. But okay, so interesting. The price target decrease is no disrespect. I'm not going to mention who it is because I'm not trying to cast aspersions anywhere. But actually, the price target downgrade is one that I would normally dismiss, if that helps. Probably not a whole lot. So yeah, I guess AMAT's all right here. Actually, that's my really quick and dirty view. And if the stock drops by week's end, you'll know just how dirty it was. If that makes any sense. I found the two books you mentioned, Natenberg and Hull. Yes, Option Volatility and Pricing. That's Natenberg's book, and Hull. What is it? Options, swaps, and other derivatives or something. I'm trying to remember the title. I should know it off the top of my head, but actually I haven't picked the book up in about 10 years. Other publications that I suggest and recommend, of course, other than my own, but if you have those too, those are very good. And a lot of the things I learned from both of those. Hull is kind of a textbook, really. Obviously, we wrote a book. The Options Edge was published by Wiley back in 2016, but truth be told, if you have those two books, you're going to cover most of the topics that we go over here. I think Neil Chris, that's with two S's. The title of his book was Black Scholes and Beyond. I thought that was quite good. And, there are some other books that I think are good, but you have to be careful. So there's a book that's more of a reference text by Alexander, which is really all it is a library of models. The only issue with it is that some of those models have errors in the formulas. There's an error in the formula in our book, actually. It was, I think we had an exponent that got inverted, and an astute reader who was coding the formulas that we put in actually couldn't get it to work and picked up on it. I want to say, was it the one on page 27? No, 17. I don't. It was one of the. I think it was a put formula. So we're not immune, and if you don't put out second, third, fourth editions, these editorial mistakes that slip by, and the editors don't know, right? What do they know about an options formula? They don't catch it. So if it slips by us, then it's just going to slip into print. But yeah, I think Neil Chris is good. What else? Blythe. Not necessarily about options, but a good quantitative book. I'm just looking at the ones I have over there. And a reference test. I guess Rebanato. Some of that stuff gets pretty chewy, though, and I'm not sure how much utility it really has for day-to-day options trading. Some of these things, I like to refer to them. So Rebanato is more about correlations, and we used to trade a lot of dispersion, stuff like that. So that's when you're trading constituent stocks against things like the ETFs and associated indices, and that kind of stuff is helpful. I don't know that you really need to rush out and buy all of those, but if a lot of times I just use these things as reference text. So hope that is helpful for you. You know what? I'll probably formulate a reading list. Probably makes some sense. Chris Cottle. Was it Chris? The last name was Cottle, C-O-T-T-L-E. And again, I don't know what I did with my copy, but I was looking for it recently. It's a book called Options, Perception, and Deception. And I, as much as anything else, I liked the name of the book. I thought that was pretty good. So I think that's good. Oh, Larry McMillan, of course. I mean, I think a lot of people view his work as quite, as sort of a seminal work for the average investor. So Options for the Strategic Investor, I think that one was called, the first of his books. Okay. Costco, would an 800-820 June regular way credit call spread make sense? Yes. Okay, so somebody saw a post I put out on Costco. Yeah, that makes some sense. I like that, selling credit spreads, upside credit spreads in Costco. Commodities are recommended as an asset class to be invested in, notably Jeremy Grantham. Love Jeremy Grantham. Did I put this on there? Does Jeremy Grantham spell his name with a G, though? I always thought it was Jeremy with a J. Anyway, doesn't matter. Commodities as an asset class, are there ETFs that you can invest in? Yeah, so there are several. So you can, it's interesting. I mean, you can invest in the softs. So let me just put a couple up here. So softs, I'm talking about the agricultural commodities like corn, which is ticker, conveniently enough, corn, C-O-R-N-E. Wheat, which is W-E-A-T, if memory serves. Yes, that turns out to be correct. So you can do that on the soft side. Obviously, I don't need to tell any of you guys this, but UNG, which is the U.S. Natural Gas Fund, I've done quite a lot of trades in this. I'm going to make an important point about trading in these commodity ETFs, though. So this is the U.S. Natural Gas Fund. USO is the U.S. Oil Fund. So you have that one. Bear something in mind, though, when you trade these. And let's see if I can find something that really illustrates this. There is a roll cost in many of these. What is the roll cost? The roll cost is associated with the ETF buying the futures, and then as those futures expire, they need to then turn around and buy the subsequent future and the subsequent future and the subsequent future. So if you are looking at this, so if they own some blend, and now they're not always trading the listed futures. They used to. For the U.S. Natural Gas Fund, for example, they traded the Henry Hub gas contract on the NYMEX. That isn't entirely the case anymore. They now trade gas on swaps and do some other stuff. But effectively, it doesn't really matter. You're gonna own. So let's just. These are short dated positions. So, which is essentially, if you're speculating, what you typically want, because the long end of a futures curve in many cases is not going to swing around that much, even as the front does. That's not true for something like gold, because gold basically trades like a stock, and the only thing that really differentiates the long-dated contracts from the near-dated ones are things like cost of carry, insurance, storage, stuff like that. But for other commodities, it can really matter. The maturity can really matter. Some things, it matters from day to day, like electricity. And for natural gas, it obviously matters tremendously from month to month. So what ends up happening is if you always own the first couple of months. So if you're looking at my cursor here, maybe half of the position is, and I'm simplifying things here, is the front month and then the second month. And then as those expire, they have to sell those and then buy the subsequent, which means I'd be selling these two and buying this one and this one, which you can see are slightly higher priced. So you have transaction costs that create some kind of slippage. But you're also, very often, if you have a contango market, what's a contango market? A contango market is a futures market where the near-dated futures are trading at a discount to the longer-dated ones. If the opposite is true, it is said to be in backwardation. Near-dated futures are trading at a premium to the longer-dated ones. What happens is that if I have $1 million in near-dated futures and I have to roll out and up to higher price ones, I'm essentially getting less and less. And that roll cost is, it dilutes things over time. So if you chart something like the spot price of natural gas, what you will get is, by owning those ETFs, is not exactly the same thing. This is also the reason why a lot of times people would say something like, I used to see people on CNBC or hear them say it, and I didn't call people out, but say, I'm going to buy the VIX here. Really? How exactly do you intend to do that? You can buy VIX futures, and VIX futures have a term structure, and there's a cost to doing it. But spot VIX isn't a tradable instrument. And for most people, spot physical commodities aren't either. So when you look at a chart like the one I'm showing right now, which is just a chart of basically the front month Henry Hub natural gas futures contract, if you buy UNG as a proxy for it, you are not going to find that your returns match this precisely. So use them as a trading vehicle, not necessarily an investment vehicle. Now there is also a Bloomberg, I'm being told I'm over the 1 hour mark, but there is also a Bloomberg Index ETF. I encourage you to look that up. That's how we like to think about a whole basket of commodities, so you could do something like that. Okay, I'm going to try, because I would like to get to as many of these as I possibly can. For those of you who can't stick around any longer, it's been an hour. I apologize for keeping you, but I want to try to get some other stuff in here. Okay, when selling puts for income, here's a question. Will Steinberg asks, when selling puts for income, do you have a standard delta target? And if so, what percentage of the stock price is a good income target? I like to get a minimum of 1% of the stock price in income per month, 12% annualized, because I'm taking equity-like risk. I feel like I should earn an equity-like return at a minimum. That will vary from stock to stock, because some stocks are very low risk, relatively speaking. Staple stocks, we were talking about those before, would be examples of this where I might take less. And cyclical stocks or highly levered names would be examples of where I would demand more. And I will add one other thing, which is that I don't sell puts on companies that are not investment grade, because if you are going to get paid to take risk and you're at the bottom of the cap table, which is what you are when you're selling insurance on equity, I don't want to do it in a place where it's probably not priced as efficiently as it is on the credit side. So if the company does not get a BBB minus or better on the credit side, there's a good chance I would be unwilling to be naked short downside. And I can think of a few cases where I made exceptions to this rule, and I usually regretted it. What happens is you get encouraged to chase high premiums, but I'm just telling you that in general, I don't think that equity options downside is the best priced measure of risk. Credit guys really dig into this stuff, and so I kind of feel like in many of those instances, you're actually better off slightly less desirable circumstances. You can actually buy, middle maturity credit. Usually you get well paid. You have actually an opportunity for capital appreciation in many cases. You can find these things trading 75, 80 cents on the dollar, and you're not, the first loss, which is what you are if you're selling puts. So just general thing. Wish I had 77,500 to do a covered call. You must be talking about Costco. Can you cover the CRM 272.50 put spread? So let's take a look. What maturity was that? I apologize. We might have to get to that one on Wednesday, but I will make sure to go take a look. Walmart grocery is a game changer. I think so that I could be a little more tuned up on some of these other questions, I will make sure to put them on the short list for things to cover on Wednesday. For those of you who have stuck around now for more than an hour listening to me yammer on, as always, I really appreciate your time and attention. Like, subscribe, notification bell, all that good stuff. Tell your friends. I like doing this kind of stuff, and I want to do more of it. And I'm trying to figure out how I can make that possible. Be sure to tune in for the next one, which is going to take place on Wednesday at 4:15. I'll see you here.